Hi, this is Kevin with Filling the Pig, and today's FTP video on personal finance is about understanding robo-advisors and automated investing. We're going to look at demystifying and simplifying what's becoming one of the most popular ways to manage investments. So if you're new to investing or just want to get a better understanding about the topic of automated investing and robo-advisors, watch this short video to learn more. In this video today, we'll be focusing on four specific areas. First, what is a robo-advisor and automated investing, where I'll lay out the different investment firms and how they're using robo-advisor and automated investing technology. Then, we'll show you how a robo or automated investing platform works. I'll take you step by step through the process so you get an understanding of how the technology is simplifying the investment process. Then we'll talk about socially responsible investing and how investing in socially responsible companies is becoming easier with automated investing technology. And then finally, we'll ask the $10 million question, is a robo-advisor and automated investing right for you? Before we get started, here's a bit of history and a little bit of commentary on robo-advisors and automated investing. The first robo-advisor and automated investing platform was launched in 2008 during the 2008 financial crisis. Originally, the platforms were used by financial advisors and brokers to help them manage their customers' financial investments. Then in 2010, a gentleman by the name of John Stein started Betterment. Betterment is considered the very first robo-advisor to operate in the financial services market. Since that time, there's over 100 platforms operating in financial services today. That's a good thing. The not so good thing is there's a lot of terminology that's used to describe this form of investing. Some of the terminology is native to the industry, some of it is marketing jargon, and at the end of the day, it kind of creates an environment that can make things just a bit confusing. So I'm going to show you how to distinguish between robo-advisors and automated investing and how to look at the landscape if you're considering investing using one of these platforms. Here is the FTP perspective on robo-advisors and automated investing. The first thing you have to be able to do is separate the business from the technology. The business, robo-advisors, are investment firms that are using automated investing technology to provide investment services. But here's the key point. Robo-advisors, when it comes to automated investing, it's their primary business. They don't do anything else from a financial services perspective. So companies like Betterment, Wealthsimple, Acorns, and Wealthfront are good examples of robo-advisors where they're using automated technology and it's their primary business. Then there is the technology of automated investing, the technology used to provide automated investing services. By automating the process, the technology looks to remove any human intervention in the process. So when you look at the robo-advisor and automated investing industry, if you can separate the business from the technology and understand it from that perspective, that'll help you understand my next slide here, which is the technology can be used by any investment firm. Automated investing can be used by full service and discount brokerage firms, and that's what's happening in the industry right now. Companies like T. Rowe Price, which have been bellwethers in mutual funds and provided a lot of full service financial services, have now added what they call their Active Plus portfolios, where they use automated investing technology to manage mutual funds for clients. E-Trade, who has traditionally been known for the ability to trade stocks and mutual funds and bonds, which is another discount brokerage firm, has what they call their pre-built portfolios. And then you've got Charles Schwab, who's following up with the intelligent portfolios, which is another form of automated investing. So in this investment landscape, there are a lot of different variations of robo-advisors and how they're using automated technology. The traditional investment firms are starting to get into it because it provides their clients with more options. Now that you've got a better understanding of robo-advisors and automated investing, let's talk about how automated investing actually works. And the easiest way to do this is to compare automated investing to the process you would go through if you were meeting with a financial advisor. So on the front end of the process, you would meet with the advisor and you would talk to that advisor about your investment goals, the investment timeline, and the advisor would ask you about risk. From there, the advisor would step away and they'd probably do some research, stocks, bonds, ETFs, mutual funds, and then they would create a portfolio for you. And once you gave them your money, they would invest your money in that portfolio, and over time, they would manage that portfolio for you. And the goal of the whole four-step process, of course, is to make you more money. Well, this four-step process doesn't change with automated investing, but it does work a little bit differently. On the front end, rather than meeting with someone and answering questions, you're going to answer those questions online. And then based on the answers to your questions, the technology is going to move directly to the create portfolio stage, where your money would be allocated into a portfolio based on the answers to your questions on the front end. Robo-advisors and investment firms pre-build portfolios so that when customers answer the questions on the front end, their monies are then allocated to the right portfolio based on the answers to those questions. From there, the technology would continue to manage the portfolio, and again, the goal is to make you more money. So the process, the four-step process, doesn't really change. The technology, though, handles it just a little bit differently. How does automated investing technology make these decisions for you once you answer the questions online? Well, the technology is nothing more than software or an application, just like any software application. So the robo-advisors and investment firms using the technology build in algorithms and mathematical equations and predetermined rules to select the right investments based on what the individuals enter on the front end on that online questionnaire. And the goal of all the technology is to do two things. First of all, to simplify the process for the investor and provide that investor with lower management fees. Lower management fees compared to if you were to go to a financial advisor or a full-service brokerage firm. Let's walk through the process one more time so you can see how automated investing and the technology is actually working. So on the front end, we're going to answer some questions, and in this example, what we're going to do is we're going to tell the system that we're going to invest $1,000. We're going to open an IRA account. We're going to tell it our investing timeline is 20 years, and that the strategy that we're going to be using is called a growth strategy. From there, the money that we fund, the $1,000, goes into a pre-built portfolio by the robo-advisor, and we'll call this just a simple growth portfolio, which is made up of ETFs, mutual funds, and bonds. And the allocation of those securities is 60-30-10. So my $1,000 is going to get allocated 60% to ETFs, 30% to mutual funds, and 10% per bonds. Then, as the technology manages my investment over time, it's going to do three high-level things. First of all, from an asset allocation perspective, it's going to make sure that my mix of ETFs, mutual funds, and bonds stays the same, 60-30-10. So if in the future I invest another $1,000, the allocation of that $1,000 will be the same. That's asset allocation. The other thing robo-advisors do is they reinvest the dividends back into the portfolio in the same allocation ratio. And then the third thing they do is what's called tax harvesting. Tax harvesting is the process of evaluating the tax benefits, the pros and cons of the portfolio to hopefully minimize the tax impact for the investor. And hopefully when that's all done, you actually make more money than with what you started with. As you can see, once you enter the information on the front end and tell the system how you want to invest, the technology and the software behind the scenes does all the work and with no human intervention at all. That's how automated investing and the technology works. Here are some additional key points regarding robo-advisors and automated investing. In regards to management fees, in general, robo-advisors are going to charge you less than the traditional financial advisor or investment firm. Generally, they have a tiered fee structure, and the more money you invest with them, the lower the fees. In regards to account minimums, some robo-advisors have a minimum to open an account. For example, Ally Invest has a $100 minimum, Wealthfront a $500 minimum. But on the reverse side, Betterment and Wealthsimple have no minimum. These types of low account minimums are what is making robo-advisors and the automated technology popular for the novice investors and those who don't have a lot of money to start investing. Types of accounts. Most robo-advisors are going to support traditional and Roth IRAs. They're going to help you with 401k rollovers, and they do provide personal investment accounts. If you get a chunk of change or something like that and you don't want to really contribute it to retirement, but you want to invest it in a growth strategy or something like that, they have personal accounts that you can use for investing. Funding accounts, you can fund an account one time, like we showed in our example where we took $1,000 to fund our robo-advisor account, or you can have automatic withdrawals take place with your checking and savings account. And finally, although we've been talking about automated technology and removing the human intervention within the process, most robo-advisors do provide financial advisors that you can talk to when you're completing the questionnaire up front. So you understand where your money is going to be allocated to what portfolio, and you pick the correct strategy so you can maximize the return on your investment. So let's talk now about socially responsible investing, or SRI, and how robo-advisors and automated investing technology is changing the investment strategy for SRI. First of all, if you don't know what SRI is, socially responsible investing, or SRI, is an investment strategy that focuses on balancing investment returns with social, economic, or environmental causes. Businesses that are arranged in an SRI portfolio are generally considered good stewards based on the way they conduct their business, not just how much money they make. The SRI themes that are the most common are environmental sustainability, human rights, and ethnic diversity. The whole purpose of SRI strategies is about aligning investors' values and passions with businesses that share the exact same goal. And to give you an example of this, if you were looking to do some socially responsible investing and your cause or core value is environmental sustainability, one of the companies you might want to invest in is Google. Back in 2017, they converted all of their facilities to 100% renewable energy. So if your goal is environmental sustainability, Google would be a company that you would invest in, and that would be an SRI strategy. So how does SRI strategy relate to robo-advisors and automated investing? In the past, if you wanted to invest in SRI related companies, you would have to do some research or have someone do some research for you to find out whether those companies were socially responsible. But what robo-advisors have done with the technology and the fact that they pre-build portfolios is they've made it easier for their customers to invest in SRI-based companies, either through ETFs like clean tech, mutual funds with companies that are maybe low carbon footprint, or maybe they're using muni bond funds where municipalities have been chosen that are practicing environmental sustainability. And the way automated investing makes it easier is that in our example in the past, we chose a growth strategy. Well, the only difference if you want an SRI strategy is most robo-advisors have what's called an SRI growth strategy. So when you deposit your money into the account and you choose that SRI growth strategy, it will immediately allocate it to a growth portfolio, which is SRI based. From there, the remainder of the technology plays out just like it did in our other examples in terms of managing that. But where automated investing technology has helped is that for the average individual out there that wants to take on an SRI strategy because from a value perspective they want to line up their money with those businesses that have the exact same core values, automated investing technology has just made it a whole lot easier. Now that you understand a little bit more about robo-advisors and automated investing, the obvious next question is a robo-advisor and automated investing right for you? Well, there's a number of ways to look at robo-advisors, but when you're just starting out, here's 4 things that you can consider. The first is, what type of investor are you and how do you want to invest your money? If you're going to be a DIY investor where you're going to manage and control everything, then you're not going to be happy with a robo-advisor because so much of it is automated, you're not going to have the opportunity to make changes. On the other end of the spectrum, if you want absolutely nothing to do with investing, then your best bet is to go hire a financial advisor and let them do the investing or retirement planning for you. However, if you're in the middle of the road and you kind of want to get started and you want to learn something about investing, a robo-advisor is a great way to minimize your risk. You'll have access to their resources or financial advisors to help you understand what you're investing in, and it's a really good way to start. So you might want to think about those things before you open an account with a robo-advisor. The other things to consider are the type of account. Are you trying to do retirement planning and you want to open a traditional or Roth IRA? Robo-advisors support them very well, including 401k rollovers. And then the other thing to consider is if you don't have a lot of money but you want to get started, robo-advisors are a great way to start because, as you saw in the previous slides, they don't have real high minimums. So you can start with $50 a month, contribute to a robo-advisor, and they're going to invest their money for you, or your money for you. And that investment strategy is what I call a set it and forget it strategy, where you're taking money from your checking, investing it into a robo-advisor, and letting them manage the investment going forward. So those are 4 things to consider before you open an account with a robo-advisor. And this concludes the FTP video on robo-advisors and automated investing. I hope you found it useful. In the future, be sure to stop out at www.fillingthepig.com and sign up to receive notification of new ebook deals, new money management articles when they post, and of course new video releases. In addition, stop out at Amazon and check out my 3-book ebook series available on Kindle and Kindle Unlimited. Again, thanks for watching.